My name's Roy Thompson. I head up Carpenter Box Financial Advisers. I just wanted to give an update or my reaction to yesterday's autumn statement given by the Chancellor, Jeremy Hunt. The big headline-grabbing items are the reduction in national insurance and some of the tax giveaways, effectively, or tax breaks that the Chancellor has set out that they intend to provide to businesses. And a lot of the people would view these as a pre-election giveaway. Certainly what's been the notion or the mutterings that I've read and heard. Behind that, though, I guess there are some issues that affect people's individual or personal finances. From my perspective, I'd like to break those down into how the pension world is perhaps being affected by yesterday's statements and some changes to the investment landscape. So from a pension point of view, a piece of legislation that the government had stated in the last budget that they wanted to bring in was the abolition of what's called the lifetime allowance. So for those people who are lucky enough to have a pension that's worth more than 1,073,100, historically there was a rather heinous tax charge that applied. There was effectively a penalty for dedicated savers who built up pots of that sort of value. In the last budget, the government announced that was going to be abolished and fully abolished from 2024-2025. And they announced in the autumn statement yesterday, or they confirmed that that was the position, and that the detail of how this the pension landscape will look would be provided in the autumn finance bill, which is forthcoming. So we know more detail about that after then, but suffice to say that anyone with a pension value of north of or more than 1,073,100 will no longer face heinous tax charges. Rather, they are more likely to face tax charges that are akin to income tax. The government just simply confirming there what they had announced previously. I guess the state pension would be something that's important to most, and the government retains the attachment to the triple lock. So a valuable increase in state pension predicted for next April, and an undertaking that's the route that they want to go down from a political point of view. So with inflation being where it has been over the course of the last 2 years, there has been some talk around the government changing tact on that. They don't seem to have done that, certainly not in the statements yesterday. Something else that came up was a change to what we call workplace pensions. Just to be clear, when you become an employee of a company these days, you are automatically enrolled into a pension of the company's choosing. What the government is aware of is that people who have a number of different jobs end up with a number of different pensions, which administratively for the consumer can be quite difficult. There can be a desire, quite a strong desire sometimes, for people to have all their pensions under one roof. And the government is consulting or taking feedback or looking to bring in a notion of a pot for life. And that is one pension pot that follows you around as an individual between employers. And you would therefore be asking your employer to pay into your pension pot rather than one of their choosing. It's quite a nice notion, actually, but the workplace pension rules and regulations, indeed auto-enrolment, have actually been really successful, increasing pension savers in the UK dramatically. What we can see is that will be that the government's intent to have a pot for life is logistically very challenging. You're going to need all the pension providers to sign up for that. It will create payroll issues for employers. So it'd be intriguing to see how that unfolds over the course of the next few months and years, because whilst it's a nice notion and I can understand why we would want to work towards that, there is some logistical challenges that come behind it. So they're probably the key things from a pension point of view. From an investment point of view, I've read very little on this in terms of the main press, but some good news. If we think about individual savings accounts or ISAs, there was some conjecture that they would seek to increase the ISA limit. This is the amount that you can save into tax-free savings accounts. And the limit has been £20,000 per individual for a number of years. There was some talk about that increasing. In the end, much like a lot of the tax thresholds, there is no increase to the ISA limits. However, what they have introduced is the idea that you can increase some flexibility, the notion of being able to save into multiple providers in 1 year, the ability to partially transfer some years, ISA allowances, so some increased flexibility. Importantly, from my perspective as a financial advisor, there is also the notion that you'll have a little bit more flexibility into the types of investments that you can hold in an ISA, which is good news for a consumer. More investment choice in a tax-free environment has to be a good thing. There was also some changes to what we call real estate investment trusts, or REITs. And again, the government is seeking to use these perhaps tax beneficial or beneficial investment vehicles in an increasingly flexible manner. So again, from the consumer's point of view, those increases can be quite valuable. So they're the key takeaways for me from yesterday's autumn statement. What I would say is, if you're thinking about your personal finances and how things like the changes in the pension rules, or considering some of your investment options, it is very sensible to see a financial advisor, and certainly Carpenter Box Financial Advisers can assist you. And our contact details are 01903 534 587. Thanks very much.